So Endeavour Mining is basically leading West African gold producer. We like to say that we're highly focused geographically. We operate only in West Africa and at the same time diversified over several countries. Why we've been focusing on West Africa is simply because West Africa is in fact the second largest gold producing region, which is sometimes unknown. And it's been also the biggest in terms of discoveries for the last 10 years. We currently have 6 mines reproducing between 1.3 to 1.4 million ounces. And more importantly, we probably have one of the lowest costs in the industry, below 900 all-in sustaining cost. So just a quick reminder, I mean, if you look again, why West Africa in terms of gold production, you see 12 billion ounces, produced in this region, which is just behind China and ahead of Russia, Australia, the US, Canada. And again, that's something which tends to be a bit unknown about West Africa. If we look at discoveries, same thing. If you like, the last 10 years, 79 million ounces that has been discovered in this region. Which is, by far ahead of any other region in the world. So we've been trying to build progressively a portfolio of assets and try to have what I call a resilient business. Resilient business means that you need to have long-lasting mines. So you want to focus on mines that have above 10 years mine life. You want to be able to evolve whatever the gold price environment. Hence the fact that we're focusing on assets with below 900 all-in sustaining cost. And you want potential for more discoveries, which is what the region is providing us. For this, we're basically, spending some time on 4 key pillars: operational excellence, project development, exploration, and also portfolio management. So just quick highlights on some of them. Regional office is based in Abidjan. We've got our own planes. We've got airstrips on each of the mines. Basically means that it takes us between 1 to 3 hours maximum from Abidjan to reach any of our mine sites. I know that some of our peers, are headquartered either in Australia or in Canada. And I can tell you it's not easy, I think, to operate mines when you are based in Canada or in Australia to operate mines in Africa. So we've got a different model. All our teams is either in London or in Africa. And it's obviously much easier to be close to all our stakeholders. In terms of track record, if we look at the Q1 results, on track to deliver our guidance. I think the important one was $848 an ounce for the first quarter. Despite some increasing inflation, we are able to maintain a pretty low cost, profile in this specific environment. So beyond production, we also have organic growth with 3 upcoming projects. The first one, we published the DFS at the beginning of the year, is the extension of our key Sabadola-Massawa asset. The objective there is to increase the processing plant by adding a BIOX plant in order to have this asset to produce over 400,000 ounces a year, again, at very low all-in sustaining cost. And then we've got 2 upcoming greenfield projects, Lafigué, who's a greenfield in Cote d'Ivoire, and Kalana, which is a greenfield in Mali. The intention is to publish the DFS for Lafigué in the coming months. This is, again, an attractive project where we will be producing above 200,000 ounces for the next 10 years at below 900 all-in sustaining cost. So production and projects and also exploration. As I said, West Africa is one of the most promising regions in terms of discoveries. It's all about the what we call the Birimian Greenstone Belt, which is all the green part that you see across those different countries. And we've really been focusing for the last now 6 years on this Birimian Greenstone Belt. If we look at the last 5 years, we basically said 5 years ago, we're going to invest about $40 million a year in exploration. But more importantly, a lot of companies are saying they're going to invest in exploration. But more importantly, we said we're going to find between 10 to 15 million ounces of indicated resources. And back then in 2016, we highlighted where those 10 to 15 million ounces were to be discovered. This was the result at the end of the 5 years. We found 11.5 million ounces, and if you map the areas that were where those ounces were discovered, we're probably about 75% right compared to what we announced back in 2016. So based on that, we basically decided that, we have now a new 5-year exploration plan. And again, this time, as we're bigger, the objective is to find even more ounces. So the objective will be to find between 15 to 20 million ounces of indicated resources, with committing to $80 million, $80 million a year in exploration. And again, you have, below where those ounces are expected to come from. So it's not like, shooting in the dark and praying that God will find the answers for us. We know where those answers are, and we just need now to drill and come up with the results. And if you look at, where those answers should be coming from, you see that, in fact, 2/3 of those 15, 20 million ounces are on our 3 key assets. So it's really brownfield mine life extensions on the existing mines. And what is interesting is if you look at the last 5 years, those ounces that were discovered, most of them were at better grades than the existing reserves of each of the mines, and therefore allowing to increase the quality of the asset and the portfolio. So again, we're expecting to find those 15 to 20 million ounces over the next 5 years. Focus on long mine life assets and low all-in sustaining costs. So this is probably my favorite chart. You've got a very simple chart with bottom is mine life in years, and the right axis is all-in sustaining cost. Basically, what you want is to maintain or bring all your asset into the bottom right square, which I call the magic square, above 10 years mine life and below 900 all-in sustaining cost. Why? Well, simply because you want to be able to generate cash flow, and cash flow is important in order to invest in your assets, in sustaining, non-sustaining capex, in being able to build new mines. If you take a project like Sabodala-Massawa, we'll be investing close to $300 million, and you want to be able to finance your exploration. So you need to be able to generate cash. Obviously, with a portfolio average all-in sustaining cost below 900, in this current environment, you are generating a lot of cash, and that's what we want. We don't have any strings attached or emotion with assets. So if you take the light blue bubbles, those are all the mines that we've been divesting over the last 5 years. And the reason we've been divesting them is progressively those mines have less than 10 years mine life, higher than 900 all-in sustaining cost, and therefore they just don't fit anymore into our portfolio. So why should I spend time on investing management and cash on assets that are not generating the returns that I want? Others can do that. So if you look at the quick production outlook, for the next few years, we'll be producing around 1.4 to 1.6 million ounces. And more interestingly is obviously the target in terms of all-in sustaining cost, remaining below 900. Remember that in January when we published our guidance for the year, a lot of investors, told us, but in this current inflation environment, how are you going to maintain those targets? Well, we came up at the end of Q1 with $848, which is, far below the guidance for the year, which gives some room to maintain, the guidance that we have and hopefully not surprise anyone on meeting those targets. With low all-in sustaining cost, comes cash, and with cash, strong balance sheet. So if you look at, the last few years, the first 3 years between 16 to 19, we've been building key mines, Houndé and Ity. We spent nearly $1 billion in cash into the business, hence, the high leverage we had at the end of Q2 19. But thanks to, again, this gold price environment and the low cost of the portfolio, we've been able to generate massive cash flow. Just last quarter, we generated close to $200 million of net cash, and therefore we've been able to continue on our journey of increasing dividend and doing some buybacks to increase our returns for shareholders. So looking at my 2 last slides before someone shout on me. Attractive shareholder returns. The policy is simple. A minimum fixed amount growing every year. A minimum as long as gold price is above 1,500, and then we can supplement this with higher dividend and buyback. And if we look at last year, I mean, the target was 125 million. We did 140. And on top of that, we did about $140 million of buyback. So if we look at, cumulative shareholder returns to date over the last 18 months, $369 million. And obviously, again, with this gold price environment continuing to generate strong cash flow and therefore ability to increase those shareholder returns program. Finally, some upcoming catalysts. We'll be publishing next week, I think, our sustainability report. Expect also the DFS for Lafigué, which is the next greenfield project we launch into construction. And obviously some good surprise expected as part of our shareholder return at the end of Q2. Thank you very much.